Hello and welcome to the Weekend Investing Daily Byte of 12th of June 2024. And first, a look at the disclaimer. Please read the disclaimer fully. It's important for your own safety. And the market is now looking towards the Fed. There is a Fed meet that is due Wednesday evening. There are actually two events that are happening. One is a very important inflation number that has to come out of the US, and there is a FOMC meet to decide on interest rates. And very rarely do these two coincide. So I think it is about after 4 years that the CPI number and the FOMC meet is on the same evening. So one is dependent on the other. So if the CPI number is much further away in terms of higher inflation than what is expected, the Fed may have a more hawkish view later in the night when they speak. If the CPI is much more lower than expectation, for instance, you may have a very dovish view from the Fed. So it's a very rare combination of a day, and hence the movement in the US market is expected to be extremely volatile, because I think 6 or 7 p.m. India time is when the CPI comes out, and then 11 or 11:30 actually is the Fed meet outcome, and of course there will be a cricket match also at that time. Uh, so the move forward has been sort of changing dramatically in the last 5 6 months. I remember at the beginning of the year we were looking for 5 to 7 interest rate cuts in this year, but the inflation has remained stubborn, and that is causing Fed to postpone their interest rate cuts. As you very well know, if the inflation comes down and moves towards the target 2% mark, only then the Fed is comfortable in reducing the interest rate. So the longer this continues, a cycle of no cuts, the more difficult it is for the economy to recover and the global growth to sort of resume. India, of course, is a shining spot in the entire global growth scenario, and we are not so worried about this. But it largely depends upon the US how all markets will behave. US remains the mother market of all markets. This is the US 10-year bond yield. You can see that once the interest rates started to rise, the bond yields have gone up from nearly 3.8 till 4.6, 4.7% also recently, and now they are coming off a bit, but more or less they are getting stable at this level. I think the market may be indicating that inflation may remain stubborn and there may not be too much room for cuts. So from 6 or 7 cuts from the start of the year, we are already in the sixth month, and we are down to one cut for this year, and possibly that too just because of presidential elections. This is the long-term chart of US government bonds, and you can see that this secular down move in the bond yield from 1982 till 2020, this had become a norm. So anytime you buy a bond, it used to go up because the bond yields are always coming down. You know the inverse correlation between the bond price and the bond yield. It is only since COVID that this relationship or this trend is actually changing. And because this has been such a long trend of almost 40 years, nobody who is actually managing money today below the age of 65 has ever seen this, rather above 65 has ever witnessed a increasing inflation, increasing interest rate cycle. So all fund managers who are present today have spent their lives with the outcome that whenever you buy bonds, bonds go up. But that paradigm shift may be changing here. And in the last 4 years, we have gone from nearly 0% to 4.4%. And if this cycle were to repeat, you don't know where we may go. We may go to double digits on the US market. And if US bond yield continues to go up, it will suck in all the liquidity from the rest of the world, because nobody wants to get 6% in India when they can get 5% in US dollar terms, or 6% or 7% there. In fact, a year back there was a situation where US dollar yields were much higher than India yields. So this conventional 60-40 portfolio that you put 16 equity, you put 14 bonds and forget about it. This forget about it has ruined many people already in these 3 years, because you cannot forget about these things. You will have to go with how the trend is flowing. This is another indicator chart which shows you this black line is what had happened from 1967 to 1985, where the inflation rates came in waves. So one wave, and then it came down for a couple of years, then a sharp wave, then it came down, and then another very sharp wave. And this is the blue line is how we have been going since 2014, and it very, there was a eerie sort of match of this historical pattern. While we may celebrate here today if inflation comes down, but a year or 6 months later we may again chart this path, and that will be catastrophic for the markets. So this is something that is going to trouble us for some time to come. I don't think it's so easy to put the inflation back in the bag just by increasing inflation rates, interest rates. Anyhow, coming back to the markets, the market has become totally listless. In the last 3 sessions, we have not gone anywhere. Of course, we are consolidating and celebrating this recovery from the bottom. But in the last 3 sessions, we have really, gone sideways, which is fine. I mean, you can't expect the market to go up every day. I'll take sideways for the next 3 months also. If it means that post 3 months I will be going up, I'm happy doing a sideways as well. So Nifty up 1/4% today. Other indices also very similar. Nifty Junior 0.75%, still within this exit poll day range. The next one is mid cap index. Mid cap index is the one which is actually gaining ground every day, almost another percent added, and this is well above the mid caps, the exit poll top that we made. Small caps are also doing the same thing, again another 1% down. So suddenly in the last few sessions there has been a shift again from large caps towards small cap. If you remember, small caps were stagnating at this level for a couple of months while large caps were moving on, and now the baton seems to have been passed on to small caps once again. Nifty Bank Index again very flat, not able to really go up. But again, I mean, at a 50,000 level, not a bad situation to be at. FIIs yesterday totally, flat, minus 111 crores. The number has become so small that it is meaningless. DII is buying very nicely at 3,193 crores. There was some comment by some mutual fund manager today also that every day there is an inflow of 150 million dollars into domestic funds, and we are having to invest it even if we don't like the valuation, even if we don't like the set of stocks that we are supposed to invest in. So this is a a very key dynamic that is very limiting for mutual fund. You have to understand this, that if 100 rupees come to a mutual fund, they have to deploy at least 85, whereas a manager who is doing a PMS or a small case has no such compulsion, right? So it becomes a like a you are having to invest at times when sometimes you may not want to, or your system may not be wanting to. For instance, if the market starts to fall, I'll go to defensives or I'll go to cash, but mutual funds cannot go to cash. So there is a sense of limitation when it comes to that format of investing. Today's heat maps, some green, Power Grid, Coal India, you had Hero Moto, SBI Life, IndusInd Bank, some gainers here, but you really did not have any consensus move across any sector to talk about. In terms of the Nifty Next 50, you had more green. You had cements doing really well, steel stocks doing well. You had public sector enterprise stocks doing well. You had some retail traders doing well. You had capital goods, Siemens, ABB doing very well. Then Geofinance, there is some, I think, talk that Geofinance and Zomato could be potential Nifty candidates. That is doing the rounds. Bank of Baroda, Chola Finance, Gale, also other gainers. Adani Green, Marico, Pidilite, these were some of the losers for the day. Sectoral trends, again, the same story is repeating every day. Energy, PSU banks, and public sector enterprise. So the way the government has maintained continuity in the portfolio and in the allocation of industries, I think the market has decided to have a continuation in the sectors that are running up. So infra, energy, PSU banks, public sector enterprise, ones that have been running up so far did well. The only exception being real estate today, which did not do well, was at flat ground. Autos, FMCG were actually down. Consumption stocks also totally flat, but in general, I think a decent day for most sectors. Public sector enterprise stocks running up, not yet above the all-time high, but a good recovery happening. FMCG index is having some resistance at this previous 2024 January level, not yet able to cross it. So FMCG is sputtering there. In terms of stocks, we have Dredging Corporation. This is one of my favorite stocks. Um, it is a surprise stock in the sense that if I look at the long-term chart of Dredging Corporation, it's really gone nowhere, right? So 2003 till 2024, 21 years, we are pretty much in the same range of 1200 to 200, you can say. But it has had some phenomenal rallies many times. So that is the beauty of catching these moves and getting out when the move ends out, right? So the whole idea is that even if the stock does not do anything over 20 years, there will still be opportunities to make money out of it and then move out of it and use that capital elsewhere for a more opportunistic, cost returns from that money. Gold is flat. It is plateauing out here at 71,500. Nothing much to talk about. But tonight, when CPI data is there and FOMC data is there, gold is likely to be very, very volatile. India VIX has come down from 31, 32 levels on the election result day back to 14. So the entire volatility is back to where it was at the beginning of the year. Options sellers would be not so happy because the premiums would have collapsed. But we are now back to business as usual, as shown by the VIX. That's all I have for today. Thank you so much for watching this. Do like and share content from this channel if you actually like, and do share it with your friends and family. And if you've not yet subscribed, please do subscribe. Thanks. Bye.